Hello, good morning, good afternoon, good evening, depending on when you'll be watching this. So, my name is Dr. Bafemi Oyewumi, and I will going to be having a class. Even at this particular point in time, we'll be talking about taxation. The course is 418, tax 418. Let me just share my slides so that we can continue um, with the class. All right. So the topic is once again tax concessions granted small business enterprises. Tax concessions granted small business enterprises. So let me just put it in presentation mode and then we can continue. All right, so I believe you can see my screen. All right, so that's the topic. Um, Welcome once again. Let's move on as we continue. All right. So, what are tax concessions? Tax concession can be defined as preferential tax treatment given to some specific types of entities in certain industries or businesses for the purpose of achieving some defined economic and social objectives. So, when we talk about tax concessions, we're talking about some, we want to talk about preferential tax treatment given, to some class of companies, organizations, basically. And of course, they are for a particular reason, particular purpose. So today we're talking about those that are granted, have been, granted small businesses. That's our focus, today. One way to look at tax concession is to look at it from the privilege perspective, to say that, okay, it's a privilege granted by the government that allows certain individuals, organizations, or types of income to be free from taxation. So we're saying, hey, you're doing a business, okay, but then there are certain incomes that have been taken off, ask, burden so that you become does not suffer, tax, does not pay tax on such incomes. Concession comes as incentives, reliefs, exemptions, or credit granted under the tax law to reduce tax burden on the individuals and the businesses to encourage activities or investments. That's the meaning. That's what it means by tax concession. Let's look at some of these concessions for small businesses. Number one is corporate tax relief for small businesses. Okay, Section 23, subsection 1 of the Company Income Tax Act, CETA, Cap 21, LFN, as amended, exempt profits of a small company in a relevant year of assessment from companies' income tax. This exemption applies to companies with gross turnover, okay, of 0 to 25 million at the end of the financial year. So this is relief being granted to small companies. Any company that has turnover between 1 and 25 million is granted an exemption. What's the exemption? The exemption, means that they will not be liable to pay companies income tax. They will not be liable to pay companies income tax at the end of the year. But it must be proven that yes, that's what they've been able to garner or earn in the course of the year. All right. So, but notwithstanding, this exemption, a small company is still required. It's still an obligation to register for and obtain TIN, that's tax identification number, file its tax returns on or before the due date, comply with all other obligations stipulated under CETA, and pay all penalties imposed for breach of statutory duties. Okay, so that's the first one. The second one talks about exemption from payment on dividend, okay, payment. Now, tax payment on dividend payments. Now, whenever dividends are earned or being distributed to owners of companies, they are also meant to pay what is called, tax. They are also meant to pay tax. All right, but of course, for small companies, especially for those that are in operation for under 5 years, their dividends, are exempted from tax. Okay, small companies in the manufacturing sector, now here that manufacturing sector, dividend payment during the first year of operation are exempted from the first 5 years, from tax under Section 23, subsection 1, and then with of CETA. So that's what this one is telling us. Such companies are not required to deduct withholding tax from dividend payments. Hence, such dividends will not suffer withholding tax in the hands of the recipient. Okay, so like I said, usually when you earn dividends, you are meant to pay withholding tax. So withholding tax is deducted from you, which of course will also be removed at the end of the day when you are paying your tax for the year. All right. So this one I'm saying you don't your dividend will not suffer withholding tax, in your hands as an individual or as a shareholder. Okay. So let's look at the other exemptions. Okay. The other one talks about Tertiary Education Trust Fund. That's TED fund. Okay, and saying here that it provides that TED fund be charged at 2.5 of the accessible, depending on, of course, the year, depending on the specific period, because now that there are changes in this particular percentage, as it were, okay, of the accessible profit of the company registered in Nigeria. Small companies having gross income of turnover or less are exempted, okay, from tax, That's taxable education, tax. Okay, that's another one. Then let's look at this one again. It talks about withholding tax. So notwithstanding, these are other matters now that we have to consider. Notwithstanding the exertion of the profit of small companies, any entity carrying out qualified business with a small company is obligated to withhold tax from payment due to the small company and remit them to FRS. So the fact that you are not, okay, you are exempted for paying income tax. Okay, any company that's still dealing with you is mandated, okay, to deduct withholding tax from any money that is due to you, or for any activities that you carry out with any business relationship between the entity and the bigger ones, as it were. Okay, so small entities having fulfilled the conditions for the exemption of their profit from tax under Section 23, Section 1 of CETA are permitted to request for a refund of the withholding tax suffered. So by the time your taxes have been withheld, okay, you are expected to file for a refund, because there will be nothing that is going to offset the withholding tax against, since you are not filing yourself, or since you are not paying any tax yourself. That's the condition. All right. So you still be charged. They will withhold your money. Okay. But at the end of the day, you can ask and request for a a refund at the end of the day. So let's look at the third point here. Small enterprise whose profit are exempted from tax are expected to continue to deduct and remit withholding tax from qualifying payments due from them to other companies, provided transaction value is above 2 million or less per month. Okay, so if the amount is above 2 million, then you are meant to deduct withholding tax and remit. So the fact that you are not paying tax, number one, those that you are dealing with, okay, in terms of business now, okay, so when you have a business transaction with them, they can surcharge you and take away, part of your money that's going to be given to them as withholding tax. But then if you carry out a transaction that's above 2 million naira, you're also expected to deduct withholding tax and remit, to the government. Of course, this one started from the 1st of June 2024. Okay, this one started from 2024, June 1st, 2024. Okay, so let's look at capital allowances for small companies. We're still going to be talking about this much more in our subsequent lectures, because let's look at what we are saying here now. Capital allowances claimable on qualifying capital expenditure are to be computed and taken to have been granted to and utilized by the company in the year it was computed, regardless of the amount of company's acceptable profit. Now, capital allowances are granted in lieu of depreciation in the tax law, granted in lieu of depreciation. Ordinarily, capital allowance is supposed to be taken out of your profit so that to arrive at your taxable income. Okay, that's what the law says. But then, since you are not paying any income tax, okay, and you incur qualified capital expenditure, which you have been subjected to capital allowance, before now, it means that ordinarily you can't offset this against any profit. And so what it means is once it is granted and once it is utilized, it is taken as, utilized by the company. Okay, so one is granted and utilized by the company and it was completed regardless of the amount. So it means that at the end of the year, when you are eventually filing, that particular capital allowance is taken as final. You're not going to be reducing it or taking it away from any profit since you are not paying any tax. So it means that whatever it is that you have charged as we told as capital allowance will just remain, you know, of no effect, basically of no effect. Okay, so it means that you must be conscious of this when you are doing some little bit of tax planning, as it were, because you are not going to take this money from any income at the end of the day, since you are not paying, tax. I believe that that's very clear as much as possible. So where a small company incur qualifying capital expenditure before crossing the threshold to medium or large, all allowances for the period while it was small are taken as granted and utilized. Taken as granted as and utilized. So you're not carrying it forward. It's not a question of that, okay, let's relieve some and carry the others, take the other forward. No, you are, it's taken as a lost, item, basically, or something that is just hanging and that will just be the effect. It has no effect on any of the income since you are not paying no tax. Okay, so that's for the all the concessions being granted. Now let's look at the new tax, of 2025. That's NTA 25. Okay, 2025. The new tax act of 2025 raised the threshold for small company. Before now used to be 25 million, but has now been increased to 100 million. And of course, there's also a caveat. Your total access, fixed asset, should not exceed more than 250 million. Okay, should not exceed more than 250 million. Again, in the new tax law, a new development levy of 4% on assessed profits replaces the several, sector-specific taxes. For example, tertiary education tax, NASENI levy, okay, IT levy, that's NICHDA, IT levy, police trust fund levy. All these levies before now, they are being surcharged with 1% of this or that or whatever. Okay, but now everything has been consolidated to be one, and that is the 4%. But now for small organizations, small businesses, they are also exempted from paying this 4% development levy. Okay, that's under the new tax law. That's under the new tax law. Now, let me say this: as much as possible, the new tax law came into operation in January 2026. Whatever exam that you'll be doing, whatever class you'll be writing, you will not be, examining based on the new tax law because it just came out. The operation just started. People are still trying to put their fingers into it. So you are not expected to be examining on the new tax law as much as possible. It's still the old tax law that we'll be looking at, particularly CETA as amended in 2011, and then of course all the different finance acts. Okay, so it's important for you to get to know all of these particular points. Okay, very, very essential. Now let's talk about the benefits of tax concession. Benefits of tax concession for small businesses. Number one, reduction in administrative burden, simplifying tax compliance. That's exempting small business from VAT registration and monthly returns, help to reduce the administrative cost for small business owners. Number two, it stimulates economic growth. Tax incentives encourage investment and business expansions, okay, which ultimately contributes to a higher national output of goods and services. Of course, when you don't have to pay the tax, when you don't have to pay tax, you invest, it's like you're investing the money into your organization and you are expanding, your business. Encouraging job creation, that's the third one. SMEs are significant employers of labor. That's the truth of the matter. So it's when you don't also still pay, when you're exempt for paying tax, it means that, it helps you, to reduce your tax burden and allows you to invest in hiring more employees, okay, thereby alleviating all employment. Okay, so what are the other benefits? The other ones, we also have them listed here. It fosters entrepreneurship and innovation. Lower tax barriers encourage individuals to start new businesses. and take calculated risk. So once the tax, burden is lower, then you can actually do more in terms of research and development, and you can also do innovate, and then as much as possible see how you can increase, your business, all right, expand your business, okay, and carry out more research, and then develop your research, and then be able to come up with new innovations. Okay. Now it also improves cash flow and liquidity, and that's correct. So it means that if you as an individual, you don't have to pay tax, because you are small, those God's going to help you, your cash flow. So you have enough cash to just carry, to just hold. And then you can use your cash flow for something else. And of course, it's also going to help your liquidity. So at one particular point in time, you're always liquid. Okay. Tax exemption and holidays can free up capital that businesses can reinvest into its operations. Okay, purchase equipment and expand their market reach, which is particularly crucial in their formative years. Of course, also help to enhance competitiveness by lowering operational costs. Tax breaks help small businesses to compete more effectively with larger corporations, both domestically and internationally. So these are the benefits that we have by virtue of the fact that concessions are being granted, by the government to small businesses. And I believe that with all of this, you'll be able to learn a lot about, tax concessions given to different organizations, especially small businesses. And I believe that you'll be able to actually answer whichever questions that come, based on this. So thank you very much for being part of the class. God bless you. See you again soon.